Markets come back from their monster Thanksgiving bounce, and the first thing they decide to do this week is faceplant. Stocks went red. Bitcoin crashes 6% intraday. Japan comes out and decides, oh, you know, why don't we raise rates on y'all? And we'll talk about why that matters here in a bit. Manufacturing is quietly shrinking again, and at the same time, American shoppers just blew through record cash on Black Friday. Like nothing's wrong. So, yeah, if you're watching everything going on and you just feel like something's got to be a little off, but you're watching all of the data come in and it's booming, frankly, don't worry. You're not crazy. We're both crazy. So, stocks started off December in the red. They're really shaky after last week's big bounce that erased basically all of November's losses. Right now, you got the S&P 500 down about 0.53%. The Nasdaq down today 0.38%. The Dow tanking into close down 0.9%. Bitcoin was an interesting one because this one was down as far as 6.4%, which was its biggest daily drop since early March, before really climbing up out of the grave and ending out the day positive 1.11%. But this is going to get a little messy. But look at the overall trend. Bitcoin is still down nearly 30% from its recent high back in early October. So look at the general direction. And don't consider, we're talking about crypto. This is the crypto world where people are trading crypto and there's that little meme of them being down 50% and they're sleeping like a baby. It's nothing. And we're not even at those levels of pain yet. Not to say we're heading that way, but it wouldn't be crazy to just wake up and see that's the case. Now, in context, back to the S&P 500. November's usually a historically strong month for US stocks. But this year's gains, it didn't come so smoothly. So after finishing October at record levels, the market started November with the worst 5-day start since 2008. We've seen AI stocks get smacked because people started questioning how sustainable these insane data centers and chip buildouts are, and whether valuations have just gone completely insane or not. And then at the same time, people were suddenly worried whether or not the Fed will cut in December again. We're still, in a way, dealing with those fears, but it's not the same right now. And then you look at the hour chart for Thanksgiving. Let's zoom out a little bit because you see it was really volatile in the month of December. For context, November ended about right here. And you see there was a lot of up and down and we really went low. Looks like November 21 is where we bottomed out for the S&P 500. So there's this market flipped and then it flipped again and really recovered fast. And then it was pretty much the 21st all the way into now to where we erased a lot of those gains. So that put the S&P 500 and the Dow at their best Thanksgiving week in years, like I said, completely erasing those November losses. Then you look at the Russell 2000, that tracks more small cap stocks. That one's up about 5.5% in a week. So that's its best run since late 2024. I don't really mess with that one too much. But the only big index, so all of the other indices are performing pretty well. You look at the NASDAQ, it hasn't actually kept up. It actually finished November down 1.8%, snapping its 7-month winning streak that it was on. So it's the speculative stuff, these heavily shorted names, these overinflated AI names, depending on who you're talking to, crypto, all of that got whacked harder. And with crypto losing over $1 trillion in value by mid-November, there's just a direction you see that some of this risk-on play is headed. And yet, mood-wise, people, they're not really euphoric right now. You look at this volatility index, it slid back below its long-term average. You look at the CNN Fear Greed Index. We're still in extreme fear, but we're heading to the righter end of that scale. We're still parked there, but we're up from, I think we hit a low of like 10 or 11 before we started changing direction. The American Association of Individual Investors survey, It had about 43% of investors bearish on stocks for the next 6 months, which is about 7 points more bearish than the start of November. And that's 13 points more bearish than the historical average. So, I mean, you've got this setup. Prices are near all-time highs, but I mean, breadth is improving. The amount of stocks taking play in that direction. But then at the same time, sentiment's still nervous. We got these headlines screaming for recession every other day. Then it's war, and then it's tariffs, and then carry trades, then shutdowns, and every other apocalypse that was supposed to end the world. But I feel like we should mention this because I talk about all of the headlines and stuff, and a lot of them come off bearish. Like, it's like sell it kind of stuff. But that's not always the case because let's just go back to the stock market real quick. I want to make this case for us. If you zoom out and we look at the month, just look at the overall direction. Where's it been? So some of this short-term noise, statistically, that's just noise. And when they do mean something, they tend to just mislead people. And of course, this isn't financial advice. I'm not saying this is going to continue forever. But I mean, just look at this chart. It's pretty much straight up. And we had this super small drawdown. And then it's like right back up. That was super short-lived. But usually short-term, all of that's just buy the dip opportunities. The political headlines, the Fed scares, scary data prints, that Japanese yen carry trade back in 2024 we're about to talk about. All of those have been opportunities to buy weakness rather than the full-on end of the world. Now, like I said, who knows if that's going to continue forever or not? I mean, it's not a recommendation to go buy the stock market or go do something stupid that you'd regret, but I mean, just consider that. Now, let's talk about Black Friday and kind of the place where people absolutely did not get the memo that things are terrible. So I'm going to put it on screen. This is one of the articles I was reading about it. And U.S. consumers, despite all of the economic uncertainty that's going on, despite everything, Black Friday just hit new records. So this is good news. Adobe Analytics, which tracks e-commerce, estimates U.S. consumers spent a record $11.8 billion online on Black Friday. That's about a 9.1% jump from last year. So then they say at peak hours, this will be 10 a.m. to 2 p.m., you had roughly $12.5 million a minute running online through shopping carts. That's crazy. And then let's add in Thanksgiving Day. This is where it gets even bigger. Consumers spent about $6.4 billion online on Thanksgiving itself. So major shopping day. This was some of the categories like video game consoles, electronics, home appliances. And a lot of what people clicked, we found out, was AI-powered shopping tools and social media ads telling you what's hot or what other people's buying. That's what really drove this year's sales. Salesforce estimates Black Friday online sales hit around $18 billion in the United States, $79 billion globally. Then Shopify says its merchants used its platform, pulled in about $6.2 billion worldwide, with sales hitting a peak $5.1 million per minute, led by cosmetics and clothing. We know the people who like buying that stuff. But then MasterCard, they have this spending pulse, which tracks both in-person and online spending. And that shows the total Black Friday sales, excluding autos, being up about 4.1%. And that's from last year. So online sales, those are up 10.4%. In-store purchases, that's barely up 1.7%. So the story is that spending's there, but it's shifting more so online. And online, let's be honest, that's usually where you're more likely to find deals, that discount. And that old image of people stampeding into malls, fighting over flat screen TVs, all of that stuff's behind us. And it's been that way for a while. But initial data we got from Retail Next, it shows that US Black Friday in-store traffic, go figure, it's down about 3.6% compared to last year. So we're trending more online. Then another tracker, Sensormatic Solution, says in-store visits dipped around 2.1%, but traffic over the whole Black Friday week was up nearly 57% compared with just the week before. So, but I mean, everybody knows that's the shopping season though, so that's not too crazy. That's just an insane throw that out there just because. So instead of one insane day, Black Friday has become this week long, even month long, stretched out promo and online deals is what we're seeing, and that continues through the rest of the weekend. And here we are on Monday. So we haven't seen for sure yet, but Adobe's expecting US shoppers to spend another $5.5 billion on Saturday. We'll see what happens with that. Around $5.9 billion on Sunday. And then today peaking at roughly $14.2 billion in online spending today on Cyber Monday, which would be another record if we see a number there matching that or even higher. But the twist is that some of that record spending, it's just inflation in disguise. And this isn't what a lot of people's talking about, because these tariffs from the Trump administration, the Trump admin on foreign imports, this is what people's not discussing, have jacked up costs for businesses and households. And we've kind of been talking about that. They're barely starting to show up in the data, but Salesforce finds that despite higher overall spending in dollar terms, US shoppers actually brought in 2% fewer items at checkout on Black Friday. Order volume slipped about 1%, while average selling prices climbed around 7%. So the basket, it costs more, but it's not always because people are living larger. Sometimes it's just because of price pressure, which we have price pressure, tariffs, and then other inflationary forces out there. And then not everybody's out there balling out. We know rich people are balling out, but what about Gen Z, who are in particular pulling back hard? So this is a survey where Gen Z shoppers said they expected to cut by an average of 34% on holiday spending, which is a much sharper cut than any other age group. Gen X, the people roughly 45 to 60, peak earning years, by the way, are the only group that actually said they plan on spending more. Another survey from PwC found that Gen Z is not just trimming gift spending, they're also cutting back on travel, dining out, and purchasing clothing. They're even thrifting a lot more. And by the way, I mean, thrifting stores are throwing discounts these days. So, I mean, you put all of that together, overall, Black Friday sales hit maybe $18 billion in the United States. That's up roughly 3%. But with 2% fewer items bought and 1% fewer orders, it's kind of like disguised, like an illusion almost. And then Saturday online sales, in dollar terms, those are up about 5% year over year. So the consumer, they're still spending, but they're just stretching dollars. They're using these deals and they're relying on financing like credit cards and loans. So the National Federation, they expected total November through December holiday spending to top $1 trillion for the first time, but the growth rate is slowing. Something like 3.7% to 4.2%. That's down from around 4.3% last year. And then at the same time, the credit card debt and delinquencies, they're showing rising. More shoppers are using buy now, pay later plans to finance gifts and decor and all of this other fancy holiday stuff, decorate the house, make it look all nice. So that's tension. Spending is holding up, but more of it is being done with debt at higher prices, at higher rates. And these younger consumers, they're drawing the line. They got to pull back. They just can't do it anymore. Now, let's flip to the part that's more so about the economy and that doesn't look as nearly as cheerful. This is going to be more so on manufacturing. So today we got the latest read on US manufacturing activity. Two big gauges matter here: the S&P and US manufacturing PMI. And then you got the ISM manufacturing PMI. So PMI stands for Purchasing Managers Index. It's basically a monthly survey of executives who run supply chains. They're ordering materials, they're hiring or firing, new orders, what they're watching, pricing in real time. So a reading above 50, that's usually expansionary territory. Below 50, that's contracting. The S&P manufacturing PMI came in around 52.5, which is slightly in expansionary territory, but the ISM manufacturing PMI, this is the one markets really obsess over. It's because it has this long history and a tighter relationship with GDP. That one came in for, so this is the ISM manufacturing PMI. It came in for November at 48.2%, down from 48.7. So not really much of a move from October. But that's the 9th straight month of contraction in manufacturing, which after a brief 2-month expansion, now we're just declining. And before that, you had 26 months of contraction in a row. So this sector, it's been grinding for a while. And here's the nuance. The ISM says that PMI above 42.3% over time still corresponds to an expanding overall economy. At 48.2%, the ISM estimates that roughly consistent with about 1.7% real GDP growth and at an annualized pace. So manufacturing, it's weak, but the broader economy, it's still growing. It's just not hot. Then new orders that came in at 47.4%, that's contracting for a third straight month and dropping 2 points lower from October. Production actually improved to 51.4%. Moving back to expansion, employment fell to 44%, contracting at a faster pace and registering its 10th straight month of decline after one brief expansion back in January. Backlogs are showing shrinking. The backlog of orders index at 44%, contracting for its 38th straight month. And prices are still rising. The prices index is at 58.5%, its 14th straight month in increasing territory. So manufacturers are telling you something. They're telling us that demand is pretty choppy and its hiring is showing being cut back. Backlogs are shrinking. But input prices, the costs of things are still climbing. And that's not the combo you and I want if you're hoping for this clean, soft landing here in the economy. And then ISM's commentary shows to back that up. So let's scroll down to what people are saying. And I highlighted a couple of them. We got these respondents straight up talking about tariffs and government shutdowns and regulatory confusion weighing on their demand. And a lot of companies are holding back on hiring to really offset higher costs and weaker orders. One respondent said that they're reducing staff, changing guidance to shareholders, and building offshore manufacturing because tariffs and uncertainty make US-based production more expensive. Then another saying the shutdown has messed up access to critical data that they need, which then screws up planning, especially in where they're working out of, which is the agricultural sector. And then others are seeing more volatility in pricing, fewer long-term orders, customers only willing to place just-in-time or prompt orders because they don't trust the outlook. So the report also notes that imports and export orders remain pretty weak, with new export orders contracting for the 9th straight month and imports in contraction for the 8th straight month. So that screams as trade friction and tariff drag. And then remember, the Trump admin, they turned tariffs up aggressively on imports earlier this year, raising input costs for a lot of the manufacturers and really making these supply chains more complicated because it's harder to plan. So companies, some of them are simply just shrinking their headcount instead of trying to pass all of that through and doing what they can to keep costs from having to go up too high. Now, don't miss the ISM's notes right here that it's talking about the 58% of manufacturing GDP is contracting. That's highlight worthy. A big chunk, about 39%, is in strong contraction PMI of 45 or lower. So, yes, the overall economy is still expanding, but a large part of the United States manufacturing is under serious pressure, even as there's these few big industries like computers and electronics, food and beverage, and machinery, which are still hanging on in growth mode. But it's tough out here. The picture so far is that consumers are still spending, but they're doing so with more debt and higher prices. And we know what the heck's been going on with interest rates and tariffs and uncertainty and weak manufacturing being the result of that. Pressure in hiring and orders, demand for goods and services. So then now add in global rates and currency moves, and we land at, you guessed it, Japan. So yields on government debt, which go up when bond prices fall, jumped around the world today. This was after Bank of Japan, their governor, who hinted at a potential interest rate increase later on this month. That pretty much surprised a lot of people who thought he might stay on hold and not do anything, especially with this new prime minister trying to keep the economy supported. Japan's 10-year government bond yield spiked to about 1.879%. That's pretty low, ain't it? But that's the highest closing level since back in June 2008, with the biggest daily jump since late July. Shorter term 2-year yields even popped just above 1%. The yen strengthened about 0.4% versus the US dollar. At the same time, the 10-year US Treasury, this one, it climbed back just above 4%, ending out the day at pretty much 4.09. Now, let's talk about why this matters. Because Japan, they've been this world's cheap money machine. And it's been this way for decades, between 1999 and early 2024. So Japan kept interest rates at rock bottom levels, including below zero for 8 years, fighting persistent deflation and really trying to kickstart growth in Japan. And that gave birth to this classic strategy called the yen carry trade. And in plain English, what that's pretty much saying is somebody borrows in the yen at these very low interest rate levels. We're talking about 1.9%. You convert that yen to USD or dollars or some of these other currencies, and then you buy higher yielding assets like risk-free US treasuries and just pocket the spread. We just seen the 10-year treasury on the 10-year government bonds for Japan is 1.9%. And then we see this yield right here, 4.9%. So that's like a 3% spread right there. And pocket the spread between what you earn and what you pay for the loan. So they go out and buy some of these treasuries, they buy stocks, bonds, whatever they want, Bitcoin. But that trade works as long as Japanese rates stay low. The yen doesn't rip higher in value, messing up everything, and global risk assets don't crash. So when Japanese yields rise, like what the governor's talking about, the yen then strengthens, and that spread, it shrinks and the risk goes up. And what we know about market participants out there, some of these investors, they don't like risk. So when you're leveraged, the ethical decision would be to start selling some of their assets they bought with the borrowed yen, that leverage, which is sometimes really aggressive. They sell those assets borrowed in the yen to unwind the trade and pay back their loans. And that's why we saw this wave of volatility in August 2024 when the yen carry trade briefly unfolded. And then, like I said, it's been the buy the dip. And that's kind of what we're going against now. But now the BOJ has already moved rates out of this negative territory and hiked multiple times, with the last move back in January. Then on top of that, Japan's finance ministry plans to boost bond issuance to fund stimulus, putting more upward pressure on these yields, so to push them higher. The governor's basically telling markets, we're going to thoroughly discuss another rate hike. And next meeting, he's saying there's just this uncertainty around the US tariffs and the US economy and how it's declined after recent trade deal with the Trump admin. So there's just a lot of uncertainty regarding that. And you see how the US is a major trade player here. And US assets, or really assets at whole, are a major player here. In Japan, by the way, they're the largest foreign holder of US treasuries with around 1.2 trillion in holdings. And private Japanese investors have poured hundreds of billions into the US stock market, along with other foreign bonds over the years. So if these Japanese yields, they keep on rising and yen assets look more attractive, then money can flow back home to Japan in this case, putting upward pressure on these US yields. So whenever US yields go up, loan rates, these interest rates paid on loans, typically follow, and financial conditions then tighten. Global financial conditions, by the way, without the Fed having to do anything. So now, then connect the dots. All right, so manufacturing is weak. The consumer's still spending, but more so on credit and at higher prices due to inflation and interest rates being a bit higher. Then Japan is threatening to pull some of the liquidity out of the global system. And then the Fed, they're staring at all of this with December 10th on their mind. They got to make a decision soon. Treasury yields here have declined this year largely because of the labor market and how it's cooled enough that the Fed has felt comfortable cutting rates again. Then lower yields helped pull down mortgage rates and supported stocks in a way through the lower borrowing costs. But if treasuries pay less, stocks look more attractive. But that's by comparison. But then there's this limit to how much US yields can ignore the rest of the entire world, and especially if Japanese yields keep pushing higher. Now, let's talk about the Fed now and where really they stand December 10th meeting, because this one is closer than usual. There are 12 voting policymakers, and none of them are on the same page. There's this more likely to favor a cut side, and you'll have Governor Chris Waller there. He's repeatedly called for another cut. He frames it more so as insurance against a faster slowdown in the labor market. Then you got John Williams, the head of the New York Fed, and he's a key Powell ally. And he pretty much says that he sees room for another cut here in the near term. He doesn't know about January, but at least in December. Then Stephen Myron, who's this is that guy who's on leave from the White House, who's backed larger cuts here in the past and said that recent data should push the Fed more in a dovish direction. Got Michelle Bowman, another Trump appointee, also leaning dovish. She and Christopher Waller, previously dissented in the cuts back in July, in favor of cuts back in July. And then there's that unclear spot. We know this about Powell. He's kind of been talking, and he's even warned himself back in October that another cut this year, from their point of view, it's far from certain. We haven't decided yet. We're going data point by data point. But markets have really noticed something about him, that his close ally, which is John Williams, is now leaning towards a cut. So what does that reveal about Powell? And then Lisa Cook. She's been carefully saying every meeting is live, and including December, she's really not trying to give any hints from her perspective. Philip Jefferson, this man's a mixed show, but he's the vice chair. He keeps stressing the need to proceed slowly and cautiously, shifting trade-offs between inflation and employment. So he sees trouble in both. But I believe he's more so in the camp that these tariffs could possibly be a one-off increase, or maybe I'm getting him mixed up with somebody else. But anyways, more so onto the likely less to cut. We got Susan Collins back in Boston. She says that markets don't necessarily suggest urgency to ease policy, because she's looking at the stock market and they're going straight up. Jeffrey Schmid in Kansas City, he opposed the last cut and warns there's no room for complacency on inflation, because if we at the Fed ignore inflation, it's going to become more of a problem. Austin Goolsby out in Chicago. Uh, he was really rattled by the elevated core inflation before the shutdown, and then the shutdown kind of just messed everything up, and now they're kind of like flying blind, like everybody's saying. Alberto Muslim in St. Louis, he's thinking there's this limited room for further easing before policy gets too loose. And then Michael Barr, he hasn't committed, but says the Fed needs to be quite cautious, giving inflation staying elevated this year. So, I mean, this isn't a slam dunk, but right now we're sitting at this 87.9% chance of a cut, according to the CME Fed Watch tool. And you've got this camp that sees a softening labor market and wants to front run any sharp downturn. And then this other camp who's worried about inflation, they still see that as an issue and it being sticky, like rice, especially with these tariffs and higher input costs. And then this consumer who's still willing to spend, even if it's on credit. And that's why every data point this week and why Powell's speech tonight, I think it started at 6, so that was 2 hours ago. It's important, and I'll probably make a separate video on if there's any news from it or anything, because markets, they're for sure going to be watching what he says, but I'd imagine we're still in the Fed's blackout window. They're not really supposed to, historically, they don't give us too much information. That's why it's like the blackout window. So Powell might avoid discussing anything about the Fed's view on monetary policy or the economy. But if they did, if he leans into Waller Williams type of language that markets can sniff out, it'll probably lead to a higher probability of this December rate cut. Like I said, we're at 86% chance of a 87.6% chance of a Fed cut in December 10th. So if he leans into this more cautious stance, like, or no urgency, the odds just shift way back in favor. But right now, this is where we're sitting. So if odds were to really increase, if this hits, say, 100%, then we're talking about the odds of a possible 50 basis point cut coming back. And we'll see that on the chart. This will get moved over to the middle and we'll see a little 3.25, 350 range. But I digress. We'll keep on watching that. Now, layered on top of all of this is this AI trade. And when Google rolled out Gemini 3, its LLM, the large language model they decided to build out, it did some things. It reshuffled the AI leaderboard for Wall Street tech. Tech investors basically then view two AI baskets. It's Team Google, which is basically Alphabet, Broadcom, TTM Technologies, Celestica, Lumentum, and then there's that OpenAI, the original, NVIDIA, Microsoft, SoftBank, Oracle, AMD, CoreWeave, and a few of these others. And recently what we're seeing is that markets have been favoring Google's side a bit more. Google's custom chips, the TPUs, are seen as really a credible alternative to NVIDIA's dominance, especially if they let these big players build AI compute without paying NVIDIA's king ransom prices, where they're just charging out the butt for their GPUs. Then on one day, the S&P 500 was up about 0.9%, while NVIDIA dropped 2.6%. The biggest gap like that since mid-2022, because NVIDIA's really been carrying the market. And that's a sign that the AI trade, it's broadening out. You don't necessarily need NVIDIA to go up every single day for this AI theme to continue to power the indices, because now we got some of these other players. And the OpenAI complex, it has more leverage, it has more debt, and we've seen this circular nature of that debt behind some of its capex. That introduces this economic risk, though. And if those massive investment plans don't pay off, that's where stuff can hit the fan. But that's not this major macro crisis by itself. It's more so about these winners and losers inside of AI, just like the dot-com bubble. Some of those companies made it to the other side. Some of them disappeared. Some of this AI will fail, but not all of it as a whole. And historically, heavy capex into new tech tends to drag earnings in the short term, but boost productivity and profits over the long term. So these investors, they're tolerating more volatility in earnings, mainly because they're betting on the eventual gains being huge, but we don't know if that's going to be the we don't know if that's going to necessarily work out that way. And then that's where productivity comes in. The US labor market productivity growth has been running pretty hot recently, averaging about 2.2% a quarter since 2023, with 3.3% pace in the second quarter of this year. That's been mainly driven by AI. Less by AI and more so into this investment we're seeing into new business formation and post-pandemic efficiency gains, especially in things like services, like hospitality and restaurants. Some of these industries did see massive jumps because they had to do more with fewer workers. So what we're seeing is that they're getting a little bit more productive since the pandemic. But those easy gains that we've seen, those are fading, and they're fading pretty quickly because labor force growth is essentially slowing. And it's slowing because of these demographics, and economists expect labor to contribute to only about 0.3% to potential GDP growth in the coming years, down about 0.8 points. The consumer spending growth is also expected to cool out a little bit. Personal consumption was up 2.9% back in 2024, but then these forecasts, they're only calling for around 2.5% in 2025. And in 2026, 1.8%. So if it's labor's not growing much and consumers are slowing, productivity has to carry more of the load in that case. And that's where this problem arises. Even though companies are throwing hundreds of billions of dollars at AI, actual AI adoption in day-to-day production, it's still pretty low. One census survey says only about 10% of businesses use some kind of AI in production as of September. That's up about 3.7% a year earlier. Other surveys show higher usage, but the bottom line is, man, we're still pretty early to this revolution. We still got a long way to go. It's just these LLMs, smart encyclopedias, could do a couple like generate pictures and everything, but I mean, history tells you the gains take time. There's economists that talk about the productive J curve. My name's Joel. New tech often hurts productivity at first because you're investing, restraining workers, re-architecting processes before the benefits even kick in. Like, you got to light that money on fire so you could figure it out. And we saw that with computers back in the dot-com bubble, from the late 1970s into the late 1980s. Productivity, it pretty much, the growth stayed sluggish even as these PCs exploded in the markets and everybody just had to see one. And people joked, you can see the computer age everywhere, but in the productivity stats. Then in the mid 1990s, productivity shot up around 3% a year. So, like I said, it takes a while, and things take a lot longer than you think. And then, I mean, we've seen that story time and time again with older tech, like electric motors and factories who started using them back in the 1880s. But the real productivity boom took decades because companies, they had to redesign entire workflows to take advantage. So AI is likely to follow a great path, yeah, but great long-term, messy short-term. And if AI-driven productivity gains don't show up fast enough that the US could face a combo of slower growth and stickier inflation and tough choices on taxes and spending, especially in the government obligations, which are rising. So, I mean, from the Fed's point of view, we got a mouthful today, but they're trying to navigate right now this cooling but not collapsing labor market, this weak manufacturing, a still spending but increasingly debt-heavy consumer where you just gotta lift your eyebrow at it, global pressure from rising Japanese yields, a possible carry trade unwinding, and this AI boom that could boost future productivity but may drag near-term earnings. Because remember, we're lighting money on fire until we figure it out. And they have to decide, back to the Fed, whether another cut here in December is too risky or is it just insurance? Can we justify a cut? Now, really, the things that will really pick the direction we're going to sway, it'll be the data that we get, the speeches we get. And that's what really sets the stage for this December 10th call, and everybody's going to be watching. So we already kind of talked about the PMI data and ISM manufacturing. Maybe Jerome Powell after this. I'll let y'all know on that. Just be on the lookout. But remember, for the PMI, that tells you this thing, that some pockets of manufacturing are hanging on in there with this coming in at 52.5 above expectations. It's an increase. Manufacturing is hanging on in there. And then the ISM PMI, this tells you another thing. All right. Hiring and new orders are soft. Tariff uncertainty. Higher prices are doing real damage. So for the rest of the week, it's just going to keep on coming in, y'all. So as early as on Tuesday, we're going to hear from Michelle Bowman. She'll testify. Markets are really going to try to listen on any hints about growth, about inflation, about financial stability. If we don't get anything and it's a nothing burger, it's a nothing burger. But people are hopeful. They're going to try to get anything they can. But remember, she's one of the ones more cautious on cutting. So watch that. Auto sales for November. This just gives you a window into the big ticket consumer demand at these higher rates. Car prices have barely come down, but I don't know. I don't feel like this one. I feel like that's going to be a nothing burger. But essentially, strong auto sales say the consumer is still willing to finance these big purchases. Weak numbers that just reinforces the cautious consumer narrative. We'll get ADP on Wednesday. Private payrolls. We got this consensus of about 40 to 42,000 jobs. Now, remember, we all know that ADP, it's not perfect, but it kind of shapes the expectations going into the delayed non-farm payrolls report later on that we'll get this month. Import price index, headline, and ex-fuel numbers are pretty much what everybody's going to be watching. These are some of September's delayed numbers. This speaks into how much imported inflation is still in the pipeline, especially the relevant given tariffs, which is why a lot of people is going to be watching them. Industrial production, this is another September delayed report. Real world output from factories, utilities, mines, pretty much pairs with the manufacturing PMIs to confirm whether weakness is just sentiment or actually showing up in the output. But remember, some of this stuff is delayed though, so it's going to carry a lesser weight. But all of this is going to move the expectations of a Fed cut. So final U.S. services PMI, this is for November. Let's go back to the page we were on. Boom. This services are the bulk of the economy, so that's why it's so important. And a reading around 55 says that there's this solidly expanding environment, at least for services. ISM services November, that's just like manufacturing PMI, but for services. The consensus is around 52.4 to 52.5. And markets are going to care a lot about this to see if services are strong or the Fed can't fully relax on inflation. Because like we just said, services play a huge role on the economy. Thursday, we got initial jobless claims. This is week of November 29th. Forecasts around 220,000. Claims are the fastest read on layoffs, which is why people watch those. So if they spike, that just strengthens another case for a cut. That's just more evidence on we should take the insurance route. But if they stay low, well, the labor market's still resilient. We're not seeing this deterioration in the labor market. So, hey, maybe we don't need a cut. Michelle Bowman's back again, maybe reinforcing her view, but we don't know for sure what that will reveal. And then Friday, pack day, we'll get personal income and spending. Another September delayed report. Income growth tells you how much fuel consumers have. Spending shows how much they're actually using it. We got these forecasts at about 0.4%. That's 1 percentage point higher than expected. So, hey, maybe we don't need a cut. Michelle Bowman's back again, maybe reinforcing her view, but we don't know for sure what that will reveal. And then Friday, pack day, we'll get personal income and spending. Another September delayed report. Income growth tells you how much fuel consumers have. Spending shows how much they're actually using it. We got these forecasts at about unchanged for income, 0.3% for spending, which, I mean, that's modest, but it's positive. PCE index, this is September's delayed. This is the Fed's preferred inflation gauge. And for headline PCE and core PCE, core excludes food and energy because those are considered volatile, even though that's what people spend all their money on, are both expected to be up about 0.2% for PCE, for headline PCE, and then core PCE is expected to come up at 0.3% month over month, with year over year core PCE at around 2.8 to 2.9%. That is increasing further away from the Fed's target because we were lastly at 2.7%. So if core stays elevated, then these hawks, they get to squawking a little bit louder. Hey, inflation's a problem. Hey, we probably don't need to cut. But if it comes in cooler, doves get more ammo. And then another big one we'll get, University of Michigan consumer sentiment. This is preliminary for December. So the consensus is around 52. That's up from 51. So barely a move up, but it's a move up. Conditions are getting a little better. This really tells you how households feel about their finances, jobs, and inflation going forward. Then consumer credit. This is for October, and this really shows how much households are leaning on their ability to use debt, credit cards, auto loans, rising balances with rising delinquencies. Probably isn't what we're going to want to see heading into 2026. It just kind of sets the stage there. So a lot of people is going to be watching all of this stuff on this economic calendar. I'll be sure to cover everything going on. But this week, it's basically a stress test for 3 stories. Is the consumer really as strong as Black Friday headlines make it look? Or are they just capping? Once you adjust for these higher prices and more debt, how's Black Friday really holding up? Then the second thing, is manufacturing truly stuck in this shallow recession, or are we bottoming out and that's about to flip script? And lastly, does inflation stay tame enough for long enough for the Fed to justify another insurance cut without overheating risk assets or reaccelerating prices? Inflation. But, I mean, you've got these market internals quietly improving. Earlier this fall, people were really freaking out that there's only this handful of companies that were really dragging the S&P 500 higher. The percentage of S&P stocks trading above their 200-day moving average, the MA, that's classic breadth indicator, it dropped to around 47.31% on November 20th, the lowest since June. And then that's right around where we bottomed out. You see where it hit that little yellow on the chart? Look, right there. I'll circle it with the mouse. Right there. You see that? That's around November 20th. That's the lowest since June. And it climbed back above 54% with sectors like healthcare and some of these other laggards starting to really participate. And broader participation, that makes rallies more sustainable because you're not just relying on NVIDIA. And we're talking about how now there's 2 camps, Team NVIDIA and Team Google, because now NVIDIA is going down and the broader stock market, that doesn't want to go down. Then we also see insider behavior. It has also shifted. So back in October, the ratio of insider selling to buying on the NYSE, the NYSE, that spiked up above 27. That's an all-time high, which looked like executives, they're dumping their own stocks. What does that say about valuations, in their opinion? From their point of view, yeah, I want to go buy a nice car. Oh, yeah, I want to go get married. But the timing just couldn't have been more perfect. Now that ratio, it has slid to back about 2.5. And at these levels, it's not a super strong timing signal. But the fact that insiders are buying more of their own shares is at minimum not bearish. But people sell for all kinds of reasons. Like I said, they might need to buy their wife a wedding ring. But they usually buy because they think stocks going up as far as the stock market. Now, global flows, they tell the similar story. After Trump's tariff battles earlier back in the year, the Liberation Day, April, 20th, 420, people worried these foreign investors would then get mad, get all salty, and go sell all their U.S. assets in this sell America wave. But Treasury data shows foreign investors have really kept pouring into U.S. stocks, U.S. bonds, and that stock inflows hit a record $646.8 billion in 12 months through September. Now, that's not what a boycott looks like. That's just the world saying, yeah, your politics are kind of messy. We don't know about your president, but your assets themselves are still attractive. Like, we still like Tesla stock. Now, I don't know about Trump. But seasonally, December has been strong reputation overall. So since inception, we look at the Dow and the S&P 500. I'll just leave it on the S&P because, I mean, we already seen this chart. It's just straight up. But since inception, both the Dow and the S&P have gained about 1.3% on average in December. The Nasdaq about 1.5%. And the S&P 500, it finishes higher in December roughly 72% of the time. So that's a good little win rate. That's your classic Santa Claus rally pattern. But seasonality, it's not a guarantee. It's just more so context. And this Christmas, whether we get that smooth rally or more choppy sideways noise, I mean, it just depends on a couple levers. It's just a couple levers. How aggressive Japan ultimately gets and whether this yen carry trade stays orderly, and whether the consumer slows after the holiday sugar high wears off, especially with more debt. And then there's more. I said a couple, but then there's more. Whether manufacturing and business investment stabilize or keep on rolling over. We were just talking about these long contractions. And then this one, mark your calendar, December 10th. What the Fed signals December 10 and beyond, because there will be that Powell press conference and there will be a lot of questions about January. And then we'll just start over. Now it's January. Watch January's Fed meeting. So short term, expect more noise. Headlines about tariffs, war one day, carry trades, government shutdowns, scary data releases. They're all great at freaking people out. All in the moment. Extreme fear on CNN Fear and Greed Index. But we're just talking about it. If you look back, this could possibly be the repeat of what history showed. A bull run market over and over again. And that rather than selling, just look for opportunities and capitalize off of it. I mean, of course, like not financial advice. That doesn't have to repeat itself forever. But like I said, I'm not saying that's going to happen. But what does history say? But I mean, then again, like you get back to looking at that like Joel. I mean, this is straight up, man. There's not even a red candle on this screen. So it all just kind of depends. But whatever happens, y'all, I'll keep breaking down all of that, all of the noise, all of the signals, all of it as it comes in. And we'll talk about like, what does it mean for the economy and the markets? We'll do that here together. So thanks for hanging out with me, everybody. You have a good one and stay awesome.